Hi, everyone. I want to thank you for joining us today for our quarterly market webinar. I'm joined by Andy Reynolds, our Chief Operating Officer, Partner, and Financial Advocate, and Brian Burton, who is our Chief Investment Officer as well as Partner. Brian's going to lead us through the conversation. He's put together a number of great slides for us to look at today. And then Andy and I are going to comment on that, and we'll kind of leave you with a finishing message about where we think the markets may be headed from here.
You're right. Thanks, John. Welcome, everyone. Those of you watching live, and even if you're watching the recorded version, welcome. We're glad to have you here. So let's kick it off and start by taking a look at kind of where we are now in terms of U.S. economic growth. After all the turmoil that we've had throughout the year, particularly in April, fears of recession, depression, etc., we now have estimates that the full year growth rate for the U.S. economy will be around 2.3%, which over the last 15 years or so is pretty much the median growth rate for our economy. So it really points to continued strength that we've seen in the labor market and in turn in the consumer. And when we look at real GDP growth in dollar terms, it's really a measure of a total value of all the goods and services produced in the United States. Adjusted for inflation here. But as you can see, total output for the U.S. for 2025 looks to be in the range of $24 trillion. So on a nominal basis, we're talking about a $31 trillion economy. To put that in perspective, China is the second largest economy in the world at 19 trillion, and Germany's third at under 5 trillion. So our economy is about 6x the size of the third largest country as far as GDP. So the scale and magnitude of the U.S. economy is pretty amazing. The total global economy is 113 trillion. So our single country makes up over 25% of the global economy. So we'd be remiss if we failed to mention government spending when we're talking about U.S. economic growth. This chart looks at total U.S. government debt overlaid with the actual debt ceiling amount. So what you can see here is that we bumped up against the so-called ceilings before getting an increase. You also see what's interesting here is part of the OBBBA, the One Big Beautiful Bill. The debt ceiling was raised another $5 trillion. So the government at this point, not even pretending that we're going to try to balance the budgets, we're just going to go ahead and further expand on the deficit and overall debt load. So how much we're actually spending as a function of the overall economy, almost a quarter of our economy is driven by these government outlays now. So these expenditures are now a meaningful part of the overall economy. If you're wondering what's included in those outlays, it's broken down into three categories. Mandatory spending, which are your large entitlement programs, Social Security, Medicare. Discretionary spending is the second category. So we're talking about defense, transportation, education, those things. And now the third component, which has become quite meaningful, is just the net interest on our debt, which is now approaching $1 trillion annually. Now, if we look at the overall surplus or deficit as a percentage of GDP, what's interesting here and somewhat alarming is just even during the last few years where we've had solid economic growth north of 3%, we're still running pretty massive deficits for 2025, around 6% of overall GDP. So something to keep an eye on for sure. We've seen interest rates over the last few years prior to this most recent rate cutting cycle kicking off. We've seen an increase, and this chart looks at average interest rate of all U.S. public debt. So we can see that the interest rates here have more than doubled in just a few years. And like we mentioned, the interest expense is now around $1 trillion annually. So this is a big reason why we've seen Treasury Secretary Bessent out pounding the pavement, talking so much about getting rates down. It's that all of this debt issued over the last couple of years at a higher rate has become such a burden to overall economic growth. So I'm going to pause here for just a minute and open it up, John and Andy, if you have any comments you'd like to add at this point.
I can just hop right in. We're talking about the U.S. debt. So I do think, U.S. debt is an important thing to look at. If you go back to that slide and looking at the total debt within the United States and now the capacity to take another jump forward, it's something that at some point we're going to have to deal with. I think it's good to see Congress finally talking about it. This chart shows while they're talking about it, it's not, they just allowed it to move higher. But at least it's being communicated and discussed at this point, which I think is probably the first of many steps to deal with that. We get a lot of questions about that. It's something over our careers. If you look back of our careers here, the three of us, this is to some degree what this chart represents. Going back, over what this is 15. So if we go even further, 20 years, I think it's a big issue that we're going to have to deal with. But at the same time, just because US debt is high, it doesn't mean that it's an alarm bell that, tomorrow or 2026, that all of a sudden there's this flip of a switch. So that's a conversation we're having a lot with clients right now when we think about one of the bigger issues within the United States and long-term issues definitely has to do with this US debt, but it doesn't necessarily mean that is a red blinking screaming light that tomorrow or next month or next year is going to become a major issue for the economy or the stock market. Certainly something long term that we got to deal with, but we could see this debt stay high for quite a while and the markets and economy continue to do fairly well.
Yeah, I think it's what it is. The government is addicted to taking on more debt. Like any addiction, you need to admit you have a problem first before you can attack it. I don't think they fully admitted to the extent of the issue. Brian, will you go to the slide that talked about government spending as a percentage of GDP?
Sure.
I think it's important on this. A lot of discussion happened with around the OBBBA Act, and the thought was with Doge and some of the programs that were being considered for cuts and some of the kind of quick spending cuts that happened through DC. Again, I don't think it nearly played out in the way that many envisioned, and it was sort of messy, but there's a huge sensitivity in the economy right now to the amount of government spending. I mean, the idea of driving down spending so quickly sounds great. We can get our budget back in line and stop issuing as much debt. But clearly, we can see here that a huge percentage of our economic activity each year is actually reliant on that government spending. So if you take the training wheels off too quick, the bike falls over. And I think this is going to be a huge part of the discussion if we are going to drive the trend line down where we can at least get to maybe 2 to 3% in the negative against GDP, how quickly you do that, because we don't want to do anything that could, throw a wrench at the economy and throw us into a recession.
And to
Yeah.
that point, if you see how slowly the debt has increased, and it's really been over multiple presidencies from both sides of the aisle, it's probably going to take something like that in the reverse to deal with it. It's probably not going to be this just quick movement down. It's going to take some type of long-term plan to that Congress can actually everybody agree on and implement, but it's going to take some type of gradual movement back to a more manageable debt structure.
Great point. Let's move on and take a look at one of the hottest topics right now among economists, which is inflation. So you can see here, this is probably my favorite slide in this deck. The core CPI is the black line. You can see of late, at least year over year, we've been on a bit of an uptrend. But what's really interesting is when you break down the components here of CPI, really the uptick that we've seen in that year over year number has been caused primarily from this dark blue area, which represents core goods. So this is likely an impact from trade policy and tariffs that are actually finally starting to show through in inflation data. You can see the shelter in the light blue has continued to decline since it peaked in early 2023. But the core services X shelter has been a very sticky component to CPI, and it's really been a major driver of inflation for quite some time now. and has proved to be probably the stickiest area to actually bring down towards the Fed's target of 2%. And that's because consumers have remained resilient. They continue to spend on things like eating out, travel, and leisure. Um, Thankfully, but that has been the stickiest component. And we'll see what happens with core goods. If the tariffs actually continue to show through in that area or not will be a huge determinant of policy going forward. Now, as we turn to the labor markets, this chart shows how really since the pandemic, even a few years prior to the pandemic, we have a market where we have more demand for labor than actual supply. This is a fairly recent phenomenon, at least over the last 25 years or so. We've had more workers seeking employment than actual jobs available. This is a real challenge for the Fed. They've mentioned many times that we're seeing a weakening labor market where demand for work is declining. What's interesting, the supply is also declining in this environment. So this is a tough balancing act where the market's trying to find an equilibrium between labor supply and demand, and something that a lot of economists, including and ourselves, are keeping a close eye on. Now, as we look at wage growth, we see that wages are growing at an annualized rate of just north of 4%. So although they declined over the last couple of years, the growth rate has declined. It's still meaningfully higher than what we saw in the post-Great Financial Crisis era, where we were in the high ones, low twos for wage growth. So, and with an inflation around 3, workers are still gaining ground on a real basis with wage growth north of 4. So, guys, any thoughts on inflation, kind of the labor markets and what we're seeing of late there?
I think it's so clear. If you go back to that first chart that you were showing there, this and the following slide really, and with employment, how disruptive the pandemic was. I
Mm.
mean, it is so clear you had two substantial disruptions and sort of rebuilds, both in the supply chain and the labor market. And both of those have led to sticky inflation. And I know people are pointing to tariffs now. I don't think we've necessarily seen the real impact of sort of what tariffs may mean for inflation long term. If you listen to how companies are sort of absorbing that right now, we will see. I do think we're going to be above trend line for inflation for a while, at least trend line for the last, compared to the last, call it 15 years, pre 2022. But it's just absolutely unbelievable how disruptive it was, and it makes complete sense. I mean, people were shifting industries, leaving industries, going into working for themselves. I mean, social media influencers, like all of the things that just came out of a world during the pandemic is absolutely unbelievable. And I think it's going to. I don't know in the next decade if we will see inflation back down to 2%. I mean, I know that's the ambition of the Fed, but it just seems quite likely to me that we're going to be bouncing around a little bit higher than we've been accustomed to for a while.
I think the shelter of the housing is super interesting. You could probably write a book or make a movie about it, going back to the financial crisis. So if you think back around housing, obviously that housing crisis, financial crisis, it had such a big disruption back then, and so many builders went out of business. And there's the underwriting for new mortgages, as it should, it went up significantly. And I think in these early days, afterwards you see kind of that jump up in housing costs of ownership and the cost of sales of housing, but it was still pretty slow. I think with this, John, to your point, also that was kind of the front end of this big boom in housing costs. But at the same time, you had young people who were not, because the economy, were not buying houses and delaying starting a family and whatnot. And then you had all this during COVID, how transformational it really was. You had all that underlying history. And then at the same time, you had a huge advantage in technology, doing stuff like this, a Zoom meeting. was really unheard of, or at least very not very popular back then. And now you can have entire careers based off of technology and people working remotely and whatnot. So I don't think, not to be a forecaster of the housing market, but there's a lot of long-term trends that started prior to COVID that will be influencing housing for the foreseeable future. And private equity, moving into the housing markets. That is one that I think if we look over our careers, like it will be a really, really interesting story to see how all the influences on that impact us. So I'm in the camp of I don't think housing's it may flatten out a little bit, but I don't think we're going to see a day when these housing prices come down significantly, at least not anytime in the near future.
I mean, the shortage is so real. I mean, that you can attribute a lot of that back to the financial crisis and the way that development happened in the years to follow. Warren Buffett spoke about that soon after the financial crisis, that he was predicting a housing shortage over the next 10 to 15, 20 years. And I think we're seeing that both in price appreciation and just the inability for new families to acquire a home. I mean, if you poll young people, most are now looking at that as sort of an unattainable purchase, where it used to be a lot easier for someone who had sort of a average income, above average income job. And you get into these metro markets, it's almost impossible for them to purchase a home.
If you look at the younger people and their percentage of their budget tied to healthcare, childcare, and I had a third one, healthcare, childcare. Um, gosh, that just it lost me. But anyway, if you look at
iPhones.
iPhones, if you look at the amount that they're paying today out of their budget versus what was being paid 20 years ago, it's significantly different.
It is, yeah. I mean, the resiliency in the housing market's been mind-boggling to me. Just thinking about, interest rates, mortgage rates, market's still flourishing in the face of mortgage rates doubling, from a few years back when we were financing at 3.5% to, you know, folks now to financing in the sixes and low sevens. It's amazing. I've had real fears that it would put, the housing market in a kind of a gridlock, and we really haven't seen that too much to this point. So,
Housing was my third, obviously.
there you go.
Yeah.
So let's move forward here and take a look at a chart of the U.S. Treasury yield curve. So we're looking at bills, notes, bonds going out 30 years here. The yellow line is the curve from 1 year ago, with the green line being as of today. So the takeaway here is we're seeing a normalizing of the yield curve. So the long end is now above the midterm. So a transition after a very long period of inversion between the 2 and 10 year yields, where yields on 2 year notes were actually higher than that on 10 years. That curve is now uninverting, and it's actually steepening. So this current shape suggests that markets are pricing in further rate cuts, and it's also shows that the odds of an immediate recession have somewhat softened. So a pretty big change from 1 year ago, and it's a much healthier curve. Anyone would tell you that this is definitely a better shape for the yield curve in a more healthy state. So let's move on to markets. So as you can see here, asset class returns. September was very strong. Emerging markets led the way. The S&P notched a record high for a fourth or fifth, consecutive month. Bond markets rallied as yields came down, and emerging markets had a very strong performance on the back of the U.S. dollar weakness. As far as sector performance, the Mag 7 again is kind of driven the tech sector higher. You had a big month for Apple, Alphabet, Tesla. So those growth and momentum factors have continued to drive equity returns. As far as profitability metrics for the S&P, equity fundamentals remain strong despite pretty modest economic growth. Operating margins continue to expand. Return on equity has continued to improve. So these fundamental metrics that we look at, in the state they're in currently underpin this sustainability of kind of this upward trend we've seen in earnings for Q2 and Q3. Um, it's an interesting chart here of capital expenditures on AI, which have boomed. It's been driven by your four mega cap tech companies that are known as the hyperscalers. So we're talking about Apple, Microsoft, Google, and Meta here, companies that are servicing the AI build out, semiconductor producers, cloud computing, data centers. They've all shown exceptional earnings growth. Um, what's interesting to note here is that up to this point, hyperscalers have been able to fund AI spending from their own cash flows. So really, the higher interest rates really haven't been an obstacle up until this point. But what you see is that CapEx now, and particularly the forecasted CapEx over the next several months, is far outpacing the expected spend is far outpacing free cash flow. So how these companies handle that going forward. Are they going to lever up to and meet these kind of expected expenditures? How will the market judge these companies going forward if they are taking on debt here? Will the market expect profitability quicker, or are we still just going to be focused on revenue growth? That's going to be huge for the markets going forward. So. Again, I'll turn it over to you, John and Andy, if you have any comments on the markets, AI, or the yield curve.
We go back to that slide real quick with the performance S&P. So I had a really good long conversation yesterday with a well-respected client. Some takeaways I thought, last night about that conversation is a handful. One, similar to the US debt, just because if we look at these returns, 5 months in a row, all-time highs, we look at valuations, maybe they're getting a little bit stretched. We don't necessarily have a causation relationship. It doesn't mean that we're going to have a pullback. We can see valuations go on for quite a while. So as asset managers and investment managers for clients, I think it's important that we recognize these things and look at them for what they are. Um, John, you've focused a lot on AI, so I'll let you talk a little bit about the AI side. But I think from our perspective in navigating this with clients, I think it's important to recognize that we can hit all-time highs for many years in a row and keep moving up. We have done that. Um, we are sitting at all-time highs. It's been a steep curve up, but it doesn't necessarily mean that a recession or some major type of pullback is coming. That being said, it is a cyclical market. It's a cyclical economy. Things go up and things go down. It's boom bust cycles. That's the downside of having a free market and having liquidity in the market. So when I look at this, I look at it as our responsibility to really try to own these asset classes responsibly. I also look at it as an opportunity to just kind of hit the pause button with clients and just say, hey, where are you at? Where are you in your plan? And is there the potential where maybe we pull forward a decision by a year or two and we say, hey, we're going to get less aggressive in our account a couple years from now, but if you're in the camp where you're feeling really nervous, maybe we accelerate that. What's the trade-offs for that, pros and cons? But I also look at it as if you're an accumulator, you know, there's still things that look really good and the economy does look really attractive still. So, I look at all these and it's nice to see the non-US. It's nice to see that function and money being attracted to that. And if you think about it as kind of investment management 101, money's flowing to more attractive valuations. So I just want to share that as, I thought it was, I was reflecting on that meeting last night and I thought it was just a really good perspective just to remind people of.
There have been a lot of comments, particularly over the last couple of weeks, about, why is the market resilient? Why is the economy resilient? And, it used to be, and I'm going back decades, that the stock market was a measure of economic activity. It was essentially measuring some multiple of the profitability of the underlying companies. there is some belief today, and I don't think this is exclusive to today. I think it's been developing over the last 20 years. This economy is highly reliant on the high-end consumer, those that make in the top 10 percentile of incomes. That's just generally speaking, we're a consumption-based economy. About 70% of GDP can loosely be tied to the consumer. And of that, a huge concentration of that is in the top 10% of income earners. Simultaneously, 87% of stock market ownership is attributed to top 10% income earners in some way. So you have this sensitivity that's created. Markets do well, people feel better, they spend more money. People spend more money, that does better for the companies and therefore the stock market. The risk becomes, is there an increased sensitivity where if there was a, I would say, non-economic reason for a market pullback and people start to feel a little less flush, does that in fact have a ripple effect back into the economy and therefore a ripple effect back into the markets? And I think that's something we just need to be conscious of because the markets are just, everyone is aware of how markets are doing. And I think it actually is helping buoy the economy in some ways. More so, I think it's done that in the past, but I think more so today than it's done in a while. When you go to that AI chart, I wanted to make one quick comment on that, the last one that you showed. So yeah, this is a great chart. And I think we've all known the magnitude of the investment. I think this is really great to put it in context of, yes, there's been a ton of money put into AI, but so much of this is just on the free cash flow that's been generated by these companies. And now we're crossing over into this of, are they going to be using cash on the balance sheet that's not being generated on an annual basis to invest in this? Why are these companies so motivated to do it? This is, for these companies, the greatest opportunity that they've seen in decades for the companies that have been around, more than a couple of decades. But it's also the greatest threat because there is going to be so much disruption. And if you think about the established position of Apple or Google in search, think about the threats that AI bring to this. So yes, it is about investing in to the new frontier and being the leader in that, but it's also about defending their turf and making sure that they're positioned to protect the market share that I think is very much up for grabs. I think, Google would be the biggest example of that. I mean, they see very, very clearly that, when you go, and that's become what we Google something, right? There will be a new tool down the road that we go to instead of it. And I think they see that threat, and that's why they can justify this investment. The odd thing about this dynamic, though, is you have this interconnectivity of all of this. So, NVIDIA has been really the biggest beneficiary, now the largest company in the world by market cap. So much of that spending's come from those four hyperscalers that Brian mentioned. So NVIDIA has a sensitivity to the spend from those four companies. And so how they behave is going to have a huge impact on how the Mag 7 and particularly those four names mentioned do over the coming years. And then NVIDIA on top of those four.
Yeah, that's a good point. That's the circularity argument that's come up, the debate. Kind of these companies just buying from one another to
Right.
to stay propped up. Yeah,
Yeah.
yeah, yet to be determined, but certainly interesting. So let's put a bow on all of this and kind of what we're looking ahead the next few months into next year. So some of the key indicators that we're watching, obviously, inflation surprises. So as we mentioned, does trade policy and tariffs creep into kind of this inflation number and that throw off the Fed's path, right? So can the Fed continue this rate cutting cycle if inflation creeps up? What will happen in that scenario? Something we're looking for there. Can wage growth continue at the pace that it's growing, and can the labor market stay healthy if the economy does slow a bit? Obviously, trade policy, what's happening on that front. That's been, the volatility that we've seen this week so far, U.S.-China relations. And markets are pretty sensitive to this information at this point. It's all still relatively new and uncertain, and markets typically don't like uncertainty. So anytime we get a change in policy, we've seen some volatility. So how does that look going forward? Um, we're always listening to the central bank and their positioning. Are we going to get a dovish or hawkish report? Are rates going to continue to go lower? And what that does to markets. Investment and business confidence, important to follow that. Or do capital expenditure plans remain the same as elevated as they are going forward? And then just global growth data, particularly in China and other emerging markets. I think kind of the big picture, a lot of things I'm reading is basically, are we in the early stages of a productivity boom? Is AI the next great thing that's going to drive GDP growth and grow our economy to new heights? Or is AI investment masking kind of an otherwise frail economy? I think that's the debate that we're having internally, and helps us position our client portfolios in case of either of those scenarios. So I'll turn it over to you guys. If you have any closing remarks, feel free.
I'll say something and let Andy kind of close it out. I've had any number of client meetings that have been both optimistic or pessimistic, and I think there is some amount of politics wrapped up in opinion, with that. I've had a few say, I don't get it. Why is the market continuing to go up? And you can see in the GDP growth, the economy's been resilient, and I think the markets are reacting to that big picture. But at the end of the day, this is your money, right? And we need to make sure that it's positioned appropriately for you. And to Andy's point, this rally could continue. I mean, it could go on for a while. It could also stop very quickly. We could have a far different, story at the end of the year. The important thing is risk assets, stock assets. Let's just say that if you need liquidity and a significant amount of liquidity, you probably don't want your money in stocks. We're in this for the long haul. We want to make sure that you have an appropriate amount of balance inside the portfolio via fixed income or cash instruments that would give you the liquidity you need to ride out any sort of temporary dip, which market history would tell us that stock market pullbacks are temporary in nature. So, and I think seeing those other asset classes and how they've actually started contributing is just it's great for us because we've been diligent about doing that for our clients for a number of years, even knowing international up until a couple of years ago really wasn't doing much. We knew there would be a time, and you can see it in the double-digit returns they've had this year. So, patience and a long-term view is always the best thing, and not overreacting when things are good right now, and not overreacting in the other way when things get a little bit more negative.
Yeah, I would mimic that and just say what a great opportunity right now to just take a step back and just say, where are we? What do we need? What's upcoming? And whatnot. There are going to be things that break in the economy and the markets. If you've been investing long enough, you've seen it. If you haven't been, it's coming. So, look at those as opportunities to make good financial decisions. We lead with planning first here. And I think that's where you can control what you can control. Could AI stocks be overvalued? Sure. I do think the difference between now, we've seen some reference to like the dot-com bubble. I personal opinion, I think, there's more structure behind a lot of these companies than we saw back in the early 2000s. But, either way, what a great opportunity to sit at today and just say, hey, let's hit the pause button. Where are we? Are there charitable gifts we want to make? Are there debts we need paid off? Is there liquidity? Are we thinking about retirement? Let's just be a little bit more wise and intelligent about the position we're at today, and then just look to make good decisions. The market's going to go up, it's going to go down. We know that. We don't know when, we don't know how, but trying to make good decisions around it. But yeah, I think, we're here to be a helpful hand in that and navigating people through that path. This won't be the first or last question that we have about the markets or the economy. It's a continually moving path. That's what makes our jobs fun. But unless you guys have anything else, Brian, anything to add? John?
Oh,
All right. Well, we appreciate everybody joining us today. If you're watching this on replay, we appreciate you being on here. Feel free to reach out to us with any questions. If there's anything we can ever do, we're here to help.